Now, for more on what the mixed batch of U.S. economic data is telling us about the state of the economy, we are joined by Michael Woolfolk. He is the Managing Director and Senior Currency Strategist at Bank of New York Mellon. Thanks for joining us today. When we got the revision to the GDP figures today, how much of a red flag is this for the U.S. economy right now?
Well, we were certainly concerned about the numbers. It came out the same time. We had a very weak durable goods report from August. That was a little bit more troubling than the second quarter GDP. It's unusual to see a revision to a third estimate. We got one. We had a downward revision. We knew that the second quarter was going to be weak. It was a soft patch, but this was weaker than expected. It's in the rearview mirror, though. Okay, so what is your sense in terms of the third quarter? Do you think what we saw in the second quarter was just seasonal factors, or should we expect slower growth in the third or a bit of a rebound? We're going to see a rebound. Unfortunately, it's not quite the rebound we were hoping for. Again, durable goods today was a bit of a disappointment. We've had some positive economic indicators during the third quarter, including recently September consumer confidence. Looks like it's beating expectations. So we're going into the fourth quarter strong with consumers prepared to spend. I think that's the best possible scenario. So we'll wait and see. But in terms of the durable goods orders, that's really telling us about manufacturing in the U.S. What's causing the slowdown in manufacturing here? Well, I think there's a lot of uncertainty going into this election. It isn't so much a choice between a superior or less than superior candidate. We need to have a choice between one of these candidates to reduce uncertainty about the direction for taxes, the direction for regulation, and whether or not we carry through with Dodd-Frank, the Volcker Rule, and a lot of other factors that are really, frankly, keeping many companies on the sidelines, afraid to spend cash, afraid to invest in capital. Okay, and speaking about taxes, we've got the fiscal cliff, which is looming. Right. Do you think investors are really paying attention to that, or are they focusing on Europe right now and haven't really digested the potential that we will see tax increases and cuts to spending? Well, the consumer is really not so much focused on Europe, not so much focused on the fiscal cliff. They're focused on whether or not they're going to have a job tomorrow, or whether or not they're going to get off of the unemployment lines tomorrow. It's difficult. It's quite difficult to hold down a job right now. Unemployment has become sticky above 8%. I think that's the main worry. There is concern in the marketplace, certainly, investor confidence about Europe, about whether or not Greece is going to exit the Eurozone, whether or not the current stimulus announced by the ECB is sufficient to really kickstart the continent. Yeah, and speaking about that, just in terms of QE3, this third round that the U.S. government has taken, or the Fed has taken in terms of stimulating the economy, do you think it's going to have the desired effect to lower that unemployment rate? Well, we can hope. We can hope, certainly. Ben Bernanke feels that more stimulus is better than less stimulus. He wants to provide as much monetary accommodation as possible to allow for growth and employment, but there are practical limitations to monetary stimulus, and really it's up to Congress, it's up to the fiscal levers to stimulate the economy right now. And again, we're going to have to wait until after the election before we get anything substantive in that area. And in terms of the markets, of course, another concern is about the slowdown in China. Do you predict that the Chinese government will step on the pedal and try to get things started again, and perhaps we could see a lowering of interest rates and a lowering of the bank reserve requirements? And if so, when do you predict that will happen? Well, I'm a big fan of China, and they have been able to beat the naysayers since 1980. You know, they have it in their 5-year plan, the 10% growth. They're going to be downshifting from 10% perhaps to 7–8%, but don't think that this is going to get us down to 5 or 4%. They're going to be able to produce solid 7–8% year after year. And the reason being is the downshift. They're turning their focus away from export-led growth more towards domestic demand-led growth. So there's still going to be quite a bit of investment in infrastructure, demand for commodities. Australia does not have to be worried about a slowdown in China, because there's still going to be a massive demand for their raw commodity exports. So we feel that, yes, I mean, China can really dial in the GDP number that they want through a reserve requirement, flexibility, through lower interest rates. They can dial in growth within perhaps even 1/10 of a percentage point, I think, at this stage.
Well, we'll have to wait and see. Thank you so much, Michael,
Yes,
for joining us.